All right, welcome back to the podcast. Today we have a wonderful episode with Brandon Avergon. Brandon and I have been working together for a while, and I know who he is and what he's done, but I want the audience to know. So, Brandon, would you mind giving people a little bit of your background? And thank you for being here today.
Not at all, Jake. And I'd also like to thank you for having me and say hi to everybody out there. I'm excited to be a part of the podcast. Just to tell you a little bit about myself. I've been lucky enough to know Jake for some time. My background is in what we would call family office services or advanced wealth planning services for wealthy folks around the world. So we have a few tools in the tool belt that we use for that. I'm excited to speak about them today, and I think a lot of them are going to be relevant to the digital ascension group folks out there.
Yeah, absolutely. We were connected. I don't even remember exactly how we got connected, but Brandon's helped us. He's consulted on PPLI with us. We worked to structure international companies. Actually, it was a client. It was a client that we had,
That's right.
a mutual client, and she was nice enough to make the intro. We've known each other for a couple years now, so I've seen a lot of the way that you're able to work with families and help structure things to make sure that their legacy planning is across everything that they're doing, and also how to mitigate risk across multiple jurisdictions,
Sure.
structure life insurance for that. Where or who did you work with in the past that allowed you to garner the amount of knowledge that you currently have?
That's a great question. Everybody loves telling their story. So mine actually began, as I said, in the family office services, but I started in the private investment side of things, helping family offices structure their investment portfolio with things like real estate and private credit and hedge funds and all of these kind of advanced tools. And while I was doing that, I was introduced through PPLI to the world of legacy planning, asset protection, tax optimization, and how powerful all of these tools can be, but equally important, how dangerous the impact of not putting these tools in place can be. And I was able to learn about both of those things. So at that time, I went to go work for a couple family offices. One called Spearhead, just outside of Palm Beach, Florida, and then from there, I went to go work for the Rockefeller Global Family Office in New York, which was very exciting for me. And I was essentially doing the same thing that I did at the previous family office, and also what I do today, which is helping folks tackle these generational legacy planning issues.
Let's say somebody has a liquidity event. That could be through their business or through an investment that they make. Hopefully here in crypto, we're going to see some of that. We've already seen a little bit of it.
Sure.
There's been a lot of people that made a lot of money on Bitcoin or ETH or Solana, other things. And, if they have this in their personal name or they don't have some type of construct around it, talk a little bit about the consequences that can go along with that. Like, is it just huge tax implications? Are they opening themselves up to creditors and lawsuits? What are the downsides to not getting this right?
So the answer is it's a little bit of all of that, Jake, that you just mentioned. The more wealth you accumulate, the more prominent you become, the greater the threats to that wealth become. And that's just the way of the world. And some of the, well, so I'll break it down into two categories. You hit the nail on the head with the first one, what we refer to as asset protection. So today I'm going to speak about asset protection and tax protection, which are very different things. Um, and I should start by saying that while I am not a legal or tax advisor, and I am not giving anybody official legal or tax advice, I'm happy to speak about these things through my experience. Again, getting back to that asset protection. So that's what we would refer to as, you touched on it, creditors, judgments, liens, frivolous lawsuits, things like that. And it's a reality of the world that we live in that, again, just as I said, as you accumulate wealth and more people become aware of that wealth, those things are simply going to become more prominent. And many of them are frivolous. And the reality is, even if they are frivolous, they can have a huge impact on a family, not just hitting their wallet and hitting their balance sheet, but the stress and the time and the energy and the resources that can come from a process like that. Um, to tell one quick story, I had a client who came to me because they knew somebody that had gotten in some kind of very minor accident that was not a big deal, but the other party of this very minor accident um, became aware that the person had wealth and really went overboard, candidly, with the claims against this person, which were frivolous, and it ended up all working out with the asset protection structures that we put in place. But the stress of the situation actually made this person that was wealthy, it made them ill. They
Oh,
became
wow.
physically ill because of just the circumstances and the drain on them from being dragged through this horrible process. And that's what we really try to prevent. And it's again, with the internet age, world is shrinking. It's just becoming more and more prevalent. So a lot of our clients are people who, because of their wealth, have a disproportionate rate of those types of attacks. The other most detrimental piece is taxation, is what you just said. And what we find, because most people, particularly people with wealth, they're working with a CPA on a year-to-year basis, and they're getting advice more or less of how they can kind of keep their tax bill in line on a year-to-year basis. But in my experience and what I've seen, where the damage is really done is when assets are passing from generation to generation. It's that estate tax liability. Of course, I have a side story for that as well, from my Rockefeller days. This is paraphrased over many generations, but the way the story goes is, the Rockefellers and the Vanderbilts are two of the most wealthy and successful families in the history of the United States. They were both able to do tremendous things. But as you and I sit here today in 2025, they're actually not quite on the same footing in terms of wealth. And the reason for that is one of these families, my previous employer, did a great job of managing their estate tax liability on a generation by generation basis, and the other did not. And it doesn't take many generations, two, three transfers across generations without properly managing that, and your wealth is quite literally crippled. Now these folks are all doing fine today. They're certainly not hurting for money, but the stark difference demonstrates exactly what just planning and managing that liability can do and how it can help.
So it's, I mean, 40% is that the estate tax today in the US if you don't
That's the
structure things.
That's the federal piece, Jake. And the reality is, depending on where you live, there may be additional estate taxes with additional thresholds. And that's where things get complicated. So I happen to live in the state of Massachusetts, which I love for many reasons. Uh, they have an estate tax on the books, estate tax of 16%, with a lower exemption than the federal tax bill. So what's going to have to happen when I pass away, assuming I still live here in the state of Massachusetts, is there's going to be two calculations going on. They're going to do one calculation on what I owe the federal government at that 40% rate, and they're going to do a whole separate calculation on what I owe the state at a 16% rate. And you don't get any credits or deductions from one against the other. You're paying both of those bills. Now, that's the bad news. The good news is the solutions that you put in place to manage one also apply to the other. So, the measures that you can take to right size your estate, to build in some of this estate tax and liquidity upon death protection, those tools are going to be able to solve both of those problems if properly structured.
And so, when you're looking at that, I mean, you get a lifetime gift tax threshold, right? So this isn't gonna apply to just anybody and everybody. You have to do pretty
That's a good
well
point.
in order to meet that point where you're gonna be dealing with the federal level. At the state level, are there lower thresholds than, next year it's gonna be 30 million between a married couple that you can pass on without the estate tax, but are there lower thresholds at certain state levels?
That's a good question, and the answer is yes. The answer is the thresholds, and we're talking about significantly lower. So, you just mentioned the way that the current tax bill stands and the federal exemption is supposed to go. Pretty soon, we're going to be looking at 30 million of exemption for a married couple. That's a nice buffer there. In depending on the state you're in, combined for a married couple, we could be talking about somewhere between 5 and 10 million is all you get. So for a single person, that's more like 2 to 5 million. And in some states, this will actually also include the value of your primary residence, which the way that, real estate markets have gone, a lot of regular people who bought their homes whenever, their homes are worth, $1 million, maybe $2 million. And they're not necessarily tremendously wealthy. They just bought it in a good time and their real estate is appreciated. Just by the nature of that, you can be subject to these estate taxes. And that doesn't even get into the things that a lot of people are more aware of, like probate, the other issues that can come in just simply from a lack of planning.
Yeah. So if you don't have your stuff put through, a trust or some other mechanism like life insurance to be able to mitigate that probate, all of that's going to become public record. And then you also are going to have to go through the process where people may be fighting
Well,
over
that's
your estate.
that's
So
that's absolutely right, and I've seen it firsthand, and it's tough to visualize because, I have these conversations with clients every day. The conversation is focused around, well, what's gonna happen when you're gone? And the first thought to them is, well, I'm gone, so I personally am not gonna have to deal with it. And then I remind them that, well, you're absolutely right. You are gonna be gone, and it's gonna be your family and your loved ones and the people that you care about most that are gonna have to deal with these problems. And, Jake, I could do hours on families who said, I am so glad that my mom, my dad put this plan in place and made this easy on us. And I have just as many stories that said, what were they thinking? How did they not address this? And it just, again, it shows that that's how much of a massive impact a small amount of planning can do.
yeah. Well, and it's an afterthought, right? Like you're so focused on your business or whatever you're doing to accumulate the wealth and provide those benefits to your family during your lifetime. And none of us want to think about our mortality, right?
Of
Like
course.
you don't want to think, well, I could be gone tomorrow. But the reality of things is things happen. And unfortunately, people do pass away prematurely as to what they're expecting to be. And sometimes they live a lot longer than what they were intending to. So you have the retirement planning in that side. But what are some of the things that you generally see with clients and work with them on? We'll kind of keep it to digital assets because that's my
Yeah,
domain. But
yeah,
when you're
absolutely.
working with somebody that has, a prominent position of their portfolio in digital assets, when's the time to start thinking about this stuff? And kind of give us some, I don't want to say guardrails, but
Sure.
just ranges where it starts to make sense.
Yeah, yeah, absolutely. So I'll start with some ranges for the good folks listening, but I want to add some context to
Yeah.
that because when you're doing thoughtful, careful planning, there are some other factors that come into play. But in terms of ranges, when you can, and this is tricky because we're talking about somebody looking at their wealth and sort of projecting what it might look like in the future. But when you can, reasonably expect that upon, your passing, even if it were to be a little bit premature, that you might be subject to some of this taxation that I just talked about. I mentioned thresholds of 2 million, 5 million. When you look like your worth upon your passing may exceed those amounts, that's when it's time to put the plan in place. Because what happens is when you take these actions, when you push wealth out of your estate, it continues to grow outside of your estate. So that you're nipping it in the bud is a way to think about it, right? Because when you take action when you're just over the threshold and you think you'll just be over the threshold, you're moving small amounts of wealth sometimes out that are then going to grow big. If you wait until you already have the problem, we talked about the lifetime estate tax exemption. That's mirrored by the lifetime gifting exemption, right? Which makes sense. How much you're allowed to push out during your life is the same as the credit they're going to give you if you pass away. So taking action when you're only using small pieces of that exemption can be hugely beneficial versus, well, now I'm over the exemption and I need to move wealth out. Well, now, you have to get really creative, and creative planning can be expensive, or you get less creative and you pay the tax. And neither of those are desirable scenarios. So you really want to be on your front foot when it comes to planning. So in terms of ranges, that's sort of what I would think about. I mean, if your net worth right now is sitting over, I'd say $10 million, no matter what state you're in, if you haven't thought about planning, you need to be on the phone immediately. But for the folks that are, you know, less than that, that doesn't mean you're off the hook. You still need to take a look at what you've got, and especially in the digital asset space where the potential for appreciation is rapid. More so than it would be if you say, "Hey, I've got a diversified stock and bond portfolio." Yeah, it's going to grow, and you can be pretty comfortable that it's going to grow. But the odds of you waking up tomorrow and seeing huge price appreciation on a basket of stocks and bonds is pretty low. Whereas we all know that in the digital asset space, it's far from a certainty, but any morning you could wake up and that could happen. So you have to be even more careful and more thoughtful, and it's even more important to think about this planning before that appreciation happens, just because it becomes a lot more difficult. The other piece of this is I talked about family and loved ones, and if you have people in your life that are dependent on you that you need to care for, this planning is even more important because there are people that are already there that you love and care about that are going to be holding the bag if something happens to you tomorrow. And this goes, past digital assets back to classic life insurance planning. Who's going to pay my mortgage? Who's going to help my children get higher education? How are we going to do all of these things? Well, that's absolutely a piece of the puzzle. And then the taxation and transfer is also a piece of the puzzle. Long answer to a short question.
No,
You'll find that to be a theme today.
well, it's comprehensive, and that's what we want to provide people here. So, in that continuity planning, when you're setting up things, you often have trusts, right?
Mhm.
In your experience, somebody that has accumulated large amounts of wealth, we'll call it over $50 million.
Sure.
Is there a normal amount of trusts that they have in place? Because most people think, okay, well, I have like a living trust, and that's
Mhm.
just what they've been exposed to, and it's revocable or irrevocable in their state. But there are a lot of different types of trusts out there, and in my experience, we're working with family offices and other wealthy individuals. They have numerous trusts that they've established
Sure.
to be able to compartmentalize their wealth, and they normally have a thesis for the family and a mission statement, core values and principles, and they want longevity, like we talked about with the Rockefellers and the Vanderbilts.
Absolutely.
Rockefellers did it the right way, and so they've been able to keep their wealth and continue to do good with it over time.
Yeah.
Uh, you may have certain thoughts about Rockefellers or whoever else, but when it comes down to it, they've done a really good job of perpetuating that through multiple generations. So
Absolutely.
when you're looking at that, is there I mean, there's probably no right answer for this on how many trusts they should have, but is it two? Is it five? Is it 10? Um, is it dependent?
So it is dependent, and that's why I'd say while there's not a right answer for how many trusts you should have, I do believe that there's a right answer for the approach. Okay. So the first right answer for that approach is you want to be working with a trust and estates attorney that has experience in your state, because they're going to understand the nuances of what's going on there. And maybe you plan to relocate states or whatever the case may, or you're looking for trust benefits in a certain state, which we'll also talk about. But you want somebody with that local expertise. And the way that I see many people approach it is there's no specific number of trusts. What you end up with is a specific list of goals and purposes. And however many trusts it takes to accomplish those goals and purposes is what you'll need. And here's an example that's just a made up example. In many cases, people will set up a trust for each of their beneficiaries. If I have 3 children, I'm going to set up a trust for each of my children. That's very logical, right? And maybe they'll be different, maybe they'll be very similar. Um, you do have to be careful. There's a lot of people talking right now about something called the reciprocal trust doctrine or the mirror trust doctrine. Basically, not necessarily worth diving into on this call, but you have to be careful when you establish your trusts that if you establish trusts at the same time that are too similar, that mirror each other or reciprocate each other, they actually lose their treatment as two separate trusts. So that is something to be wary of. And another careful thought in your planning, because what we see a lot of attorneys doing very, very intelligently is one way to differentiate those trusts is to settle them uh, apart from each other in terms of time. So people wait months. People often look to straddle different tax years to set these up. And again, your local attorney will be able to give you that specific advice. The takeaway I want you to have from that story is even when it is time to plan, this is not like going in and upgrading your cell phone. You're not walking in there one day and then walking out with a new one. This is a measure twice, cut once type of process, because when done properly, it's going to set you up for so much success. Um, but you need to be prepared to put in that thought, and even as much thought as you can put in beforehand. So I mentioned, different goals and purposes. 3 beneficiaries, 3 trusts, easy example there. Well, what if one of your goals or something that's really important to your family, which for many people it is for my family, is charitable activity? Well, would you want to have a trust specifically designed to support that charitable activity? Maybe for you during your lifetime, or maybe for generations to come. And now we might be looking at more of a foundation type of structure. So really the way you think of it is in terms of, and I use this word so much in my business, and most people who do what I do as well, and it's legacy. What we're really talking about here is your legacy is, how do you want your core values, your mission statement, everything you just talked about, how do you want that to be communicated beyond your lifetime and impressed upon your lifetime through the use of these different mechanisms? So certainly a living trust and an irrevocable trust is a good start if you're going to be over that exemption. We talked about life insurance. Um, uh, the majority of the life insurance sold in the U.S. is held in trust for estate tax purposes. That tends to be more simple. Um, but yeah, I would really encourage everybody to think about it in compartmentalizing their goals for their wealth and the purposes for their wealth, and let the trust structure be formed around that, because that's what really matters at the end of the day.
Well, then you may have things that, flow from one thing to another based on, time frames. Somebody
Oh,
that
absolutely.
is, let's say, you're a bit older, closer on time horizon, and if you have less risk tolerance, you might keep more in a certain part of your estate versus gifting all of it, or the majority
Absolutely.
of it out.
Absolutely.
And that's probably more relevant to somebody that's younger, that the closer you are to what you would think your mortality was going to be, you probably want to keep less and less in things that were in your full control versus out of your full control or your taxable estate.
Yeah, absolutely. And where you are in that spectrum and that stage of life matters.
Mhm.
We used to say on the family office and on the planning side of things, our goal for our clients is we want you to spend your last dollar on the day you pass away. We want you to spend the last dollar in your estate on the day you pass away. Now, is that realistic? No. But it's the frame of mind you want when you work towards it. So when we put these plans together, I mentioned a local attorney, being at the table and really being a driver there, because they have a hugely important role to play. Jake, somebody like you and your group, the person advising over the finances or the assets, they also have a huge role to play. So the plans that are best put together that I've seen over the course of my career were the CPA, the attorney, the advisor, and the planner were all sitting at the table and all rowing in the same direction. It's that family office team that you speak about, and there's no too much speaking about that, because it is so important, the quality of your team.
Well, and sometimes those people have different agendas, right? And you need a
Sure.
quarterback. And so oftentimes that ends up being a matriarch or patriarch that made the wealth, that understands all these things. But if you can find an advisor that is your go-to person, that can be the go-between all these professionals, that's on your side of the table to make sure that your interests are upheld, That's what we try to do for our clients. We sit in that position.
Absolutely, absolutely. And what I especially like about what you guys do and your approach and the way you go about it is, at least in my experience with you, the professionals that you bring to the table and the service providers that you use um, know the space, have a basic knowledge of digital assets. They know generally what they need to get in and do, and they're able to customize it to the client. One thing that I see in the marketplace that bugs me a little is, oftentimes I'll be working with a client and they either have an attorney, they get referred to an attorney that doesn't necessarily know much about what I do. So I find myself educating them, which I don't mind doing one bit. I talk about this stuff all day long. But then sometimes my client gets a bill because of the time I spent with the attorney educating them. And not to speak against the attorney, they're billing for their time. That's what they do. But it speaks to the value in what you're doing in having folks that don't need that education. They understand what they are what they're there to do and their role at the table. Because you're right, different folks have different agendas. So finding that right recipe, hugely important.
Yeah. You want to go to battle as a team, and like you mentioned, all rowing in the same direction. I kind of want to pivot, so
Sure.
we talk about trust, and we mentioned the life insurance, and we talked about PPLI, which is private placement life insurance,
Correct.
which you are an expert in. And so, I want to spend a little time on that and kind of drill down into what PPLI is, onshore versus offshore.
Sure.
There's some international components. A lot of people that do come into 100 million or $1 billion tend to diversify their assets across multiple jurisdictions.
Yeah,
Um,
absolutely.
and so how does that all work together? If you're doing life insurance, here in the US, we have the benefit of, I don't want to say commingling, it's probably not the right word, but combining financial products and insurance, whereas some
Absolutely.
other jurisdictions don't allow for that. So what does that look like?
You're absolutely correct. And what PPLI is, for those who understand, the basic mechanics of life insurance and cash value life insurance and how it works, is it is a cash value life insurance policy that is structured to provide increased investment flexibility. Now, what that mouthful of jargon means is basically it's a level up of what you just described in terms of in what we would call the retail marketplace is a life insurance policy that's combined with some kind of financial investment component. Maybe it's a fixed rate, maybe it's invested in an index, maybe you get a variable product that's invested in mutual funds. And each is right for the own person's situation. Where PPLI comes into that spectrum is that it takes it a step further from that last one I mentioned, where you can invest in mutual funds. And what it does is it allows the policy, based on the client meeting certain qualifications, to invest in more sophisticated products. So you heard me mention at the beginning of this call that the way I got into this space was I was working at a private investment capacity. I was analyzing and working with hedge funds and things like that. Well, my introduction was because at that time and still today, a PPLI policy can make those types of investments if the sophisticated advisor, deems them appropriate and the client qualifies, et cetera. So when I saw the power of the combination of those two things together, life insurance and alternative investments, and that was the time I decided to make this my career. Fast forward many years later, here we are today, in the digital asset space is, for many folks, equally as exciting as the alternative investment space was, 20 years ago. Um, a similar type of thing can apply. So a huge thing I'm seeing in the PPLI marketplace right now, as I just described, PPLI is this life insurance policy that can make sophisticated investments. What many of the clients, the insurers, the advisors are doing right now is figuring out the best way for that sophisticated investment to be digital asset anchored or digital asset exposed. And it's very exciting because what life insurance brings to the table is two primary things. One is tax efficiency for the assets inside the life insurance policy. So because they are inside the policy and they are, growing to support a death benefit on the contract, they grow tax deferred. So this appreciation, yield, whatever it is you might be doing, which could be anything inside this policy, that's going to occur in a tax deferred environment, which is so attractive when you've got this potential big growth, right? And then the other piece that it really brings to the table is a bit of asset protection, what we talked about, and that goes back to the history of life insurance, just as an asset class, as a planning tool. Because this policy, like we talked about, is usually going to be in trust. It's going to be outside of your estate, but also because these assets are not held in your personal name. They're held in the name of the insurance policy. That provides some quite strong asset protection, and people really appreciate that extra layer. Um, Specifically to digital assets, right? Because it's such a developing market. And while the blockchain by its nature, one of the things that's made it what it is today is its security. There's always a dual side of that. No matter how secure of a castle you build, there's always going to be somebody who's trying to break into it. Even as you as so and this is an old saying going back to cybersecurity. As the cybersecurity tools become more sophisticated and effective, so do the attackers. So you always have to stay one step ahead. And I'm sure it's very similar in the blockchain. So the tax efficiency, the asset protection is really making PPLI very popular in the space. And what your group is doing in terms of institutional custody, real advisory value with different strategies, the assets, I think really lends itself to PPLI. And one example I'll give you is in the PPLI, sort of the hottest asset class that we're seeing in the market right now is private credit or private debt, which is basically, you end up on one side of a loan agreement and you get a piece of the interest payment. Well, it's a great strategy that a lot of people are really excited about. However, it is very tax inefficient in most, depending on how you're holding it and whatever the case may be. So PPLI specifically addresses that inefficiency. And with all the great things that you're doing with digital assets, there's a bit of a mirror there where people are looking at how dividends and interest and gain and all of this might be interpreted and saying, well, either if we don't like what we're seeing or if there's uncertainty, PPLI is a great way to step in and take care of that.
You don't have to worry about it. If it's capital gains or it's interest payments or
Exactly.
income, whatever you're making on that alternative asset or the digital asset that you have inside the policy, it's gonna be tax deferred, right? And then we
Yep.
figure out the taxes later, because we don't have full clarity around it.
Well, and if you hold the contract, so everything in life insurance is tax deferred. But of course, if you hold the contract until the insured person passes away, death benefit proceeds are delivered tax free.
Right.
So at that point, the tax deferral turns into tax mitigation, at the time of the death of the insured. And there's also a really important role before I move into offshore and onshore, that a group like yours plays in PPLI. So inevitably, I get the question, well, this PPLI sounds great. What's the catch? What's going on here? What do I not know?
Sounds great, but
And
I
I
know
I
it's
get
something.
to exactly. I'm waiting for the other shoe to drop. And the answer is there isn't really a catch. What there are rules that need to be followed, that are very important because violating these rules, they basically strip away all the tax benefits. You lose everything. So the first rule is called diversification. You need to hold at least 5 different investments in your policy. No 2 investments can make up a certain portion of the value, 3 investments, certain portion of the value, et cetera, et cetera. I find in the marketplace that rule is typically pretty easy to satisfy because it looks through fund structures. So an example would be if you wanted Bitcoin exposure in your PPLI, you could subscribe to a Bitcoin ETF. You would get diversification credit for every holding inside that ETF, even though you're only in one ETF. And that's an example of how it looks through. So diversification is A, it's the right thing to do anyway, but B, it tends to be easier to navigate for the advisors because they have some tools for it. The more important rule, and by far where I see the most people get themselves into trouble with PPLI, really in my experience, one of the only ways to get yourself into trouble with PPLI is to violate this second rule, which is known as the investor control doctrine or the investor control rule. And what that states is the client, the owner, whoever the grantor of the trust, whoever is the ultimate beneficial owner of these assets, even though they're in PPLI, that person cannot be making day-to-day investment decisions on behalf of the policy. There has to be, in what we call an SMA structure, separately managed account, there has to be an advisor making all investment decisions. Now, if your goal for your policy is digital asset exposure, there are not a lot of advisors out there that can competently go in there and say, well, we can do X, Y, and Z. We can expose you to this, and we have these sort of, arrows in the quiver. Digital Ascension Group does a really nice job and very uniquely in the marketplace is able to step into that seat. Because I'll say it again, investor control is where you're going to step in it with this. You really, really have to be wary of that. And having confidence in an advisor that they know the digital asset space, they know what to do and not do, is going to give you that peace of mind.
Well, also custody and like you said, that SMA model, there's not a whole lot of people that can do that in a compliant, regulated way that satisfies all the security measures that you would likely want.
Absolutely.
The SEC's come around and given some guidance at this point, and they do allow fire blocks or other um, institutional custodial softwares, along with like just regular cold wallets. It's difficult to get um, brand new projects listed. It takes time for infrastructure to be built. So they've afforded people that, but if you are doing it in a thoughtful way, it's likely that you're going to be using institutional custody and ideally working with somebody like us
Sure.
to help you manage it. Um, so you it's great. Like this is going to grow tax free. You're able to generate things, trade things inside the policy with no tax implications. But like, what if I want to do something with it as the individual after I contributed? Is there a way to like borrow against this policy and like
Sure.
use the infinite banking concept
Yeah.
along with PPLI?
Absolutely. So let's talk about that. So there are ways to so the money gets moved into the policy and it's invested. There are ways to get it back out, to get it back into your wallet. The first is either we would call a partial or complete surrender.
Okay.
So when you surrender a piece of your policy, you're basically making a withdrawal. You're saying, I want to take this out. Now, to the degree that you're taking out premium that you put in, you're taking money out that you put in, that can actually be withdrawn tax-free because you've already paid the taxes on it,
Okay.
right? However, you need to be careful because you are playing with the economics of the cash inside your policy. So that cash value, you're reducing it, which may affect your ability to support death benefit. And now we're getting into all sorts of case design things. And that's a partial surrender. A complete surrender is where you just take everything out. And what happens in that scenario is you have to pay all the tax. All of this tax deferral that you've been getting all along is gone and the bill has come due. So because of the risk of that, there are very few situations where we would recommend a complete surrender. There are some, they're family specific and not financial related. And then because of the risk that can come with a partial surrender of playing with the economics, we hardly recommend that either. The most efficient and common way we see people access the cash inside of their PPLI policies is through what's called a loan provision, which applies to many regular life insurance policies as well. And what it basically states is that a policy owner is able to get a loan against the value of their policy from the carrier or from some other lender at what is typically a favorable rate in the market. Rates are going to run the spectrum, but because it's a collateralized loan, your policy is serving as that collateral, it tends to be a little bit more favorable And also because that collateral is right there, you can usually borrow a fair amount. So in the PPLI space, we see folks have the ability to borrow, up to 80 or sometimes even 90% of the value of their policies for cash to be used for whatever they wish. We almost never see anybody do that. In practice, that very rarely happens, but the way the loan structure works, you can certainly do that. To speak a little bit more about the loans, there are sort of three ways to approach repayment. One is we see some folks use this as basically a bridge loan, gap equity. I need the money to take care of something. I've got another liquidity event coming and I'm just going to pay it off. It works great for that, particularly because the rates are favorable. We see some folks who will just make interest payments and keep the principal, which is permitted. And there are some people who don't make any payments at all, and they just allow that interest to compound, which, depending on the value in the policy, you have to watch, but it is technically permitted. And the reason that it's permitted is because these loans are paid back most often at the time of death of the insured. So what's actually happening here is you're taking out the loan, you're using the cash. When the insured person passes away, whatever that loan balance is just deducted from the insurance proceeds. The loan gets paid off. So the way that I frame this to clients is at the end of the day, you're really borrowing from your beneficiaries or your heirs more than anyone else. So I like to say how comfortable you are with that is between you and them. But that's really what's going on here. But it's very important to acknowledge that it's what some people refer to as the living benefit of life insurance. So there's the death benefit, the money that comes in when you pass away, but the living benefit is very real and very very specific to well, not specific to PPLI, but very powerful with PPLI.
When you have to fund the policy a certain way, and there's certain provisions to where you make sure you don't mech it out, and a
That's
bunch of
important
things
too,
that
Jake. Very
don't.
important. And yeah, that all gets into some advanced case design as well. But a takeaway there is the vast majority of PPLI policies are being funded over time. So if you're putting $5 million into a PPLI structure, very rarely are you cutting a $5 million check to fund your policy. It's much more likely that you're going to cut three checks for a third or maybe five checks for $1 million, and you're going to space it out. And in one-on-one conversations we get in the reasons for that, but that's a good point too, and the takeaway that these are not funded all at once.
Yeah. So how does that work with, I want to touch on the international stuff because I know
Yeah,
that there's going to be people watching this that have a fairly large sum of digital assets that I anticipate to go significantly higher. So let's say
sure.
they're a centimillionaire. People crush it. They make a ton of money with these investments.
Mhm.
If you want to diversify across multiple jurisdictions and make sure that things were structured in a way to protect yourself, I know that you're super proficient with that. So I want to make sure people get a chance to hear you talk about some of that before we go.
Absolutely, and I appreciate that. So you're correct. So the PPLI industry is global. There are carriers right here in the United States that issue domestic PPLI policies that do exactly what they need to do, and they're good products for U.S. folks who have investment and custody goals within the United States. When you deal with an international family, you want to look for more international service providers, which we have relationships with all of the international, PPLI service providers around the world. And there are a couple of differences there. So when you work with these offshore groups, one of the things you'll see is you get opportunities for international custody and management. So as I mentioned before, with the investor control rule, the client is not holding or directing these assets. Somebody else is. So that could be somebody right here in the States, like Digital Ascension Group, but maybe you've already given, you guys are already managing a big portion of crypto, and there's another pocket of this person's wealth that they might like custodied in Switzerland or somewhere else in Europe. When you deal with an offshore PPLI provider, those types of services can often come available to you. So whether you're a US person with some international family or you want to leave or you're a non-US person, these carriers can work with folks all around the world. And the same applies to, a trust company that might create a trust to own the PPLI. You're able to accomplish all of this, without being restricted to the United States. And in fact, doing it outside of the United States gives you more of that flexibility. Another example of that isn't necessarily digital asset related yet, but certainly could be in the future, is foreign currency diversification. So some U.S. people who live here and may not even be intending to leave, but they believe in diversifying across different currencies, probably a lot similar to what you see in cryptocurrency. They have to go offshore for that to say, hey, maybe I want to make an investment in the yen, or I want to invest in this currency or that. Offshore is going to give you that flexibility. So that's an important consideration, is that if one of your goals, or you think something that would add value, is custody or investment outside of the United States, you're going to want to speak with a consultant who has a lot of expertise and experience with offshore PPLI.
Which, not to toot your horn, but I think you're one of those people.
I would say we are. But yeah, there's no right answer for, oh, offshore is better than onshore. That's not the way it works. They serve different goals, I would say.
What if I have a bunch of digital assets? Because like domestically, you pretty much have to fund these policies with cash, right? There's really not a a meaningful way to get your digital assets into these policies yet. Depends on what they end up getting regulated as and what the frameworks end up being. And,
Sure.
we're still a lot on the table trying to sort through that. But offshore, is that a possibility? Could you actually fund the policy in kind, or is it still going to be a cash contribution?
Sure. So it is possible to evaluate that. So one of the ways that we look at that situation is, different countries have different qualifications, rules that say, okay, this is real life insurance, and you're going to get the tax treatment of life insurance. Um, a U.S. or Canadian compliant policy. So if you live here or have any connection to the United States or Canada, those contributions are going to have to be in cash for you to stay compliant. If you do not require a U.S. or Canadian compliant policy, and so you have no nexus to the United States or Canada, it is possible to fund policies what we would call in kind. You have to be very wary. There are ways that things need to be done to satisfy investor control, diversification that needs to occur after contribution, and things like that. But the short answer, Jake, is it's going to take some planning and a conversation. But yes, if you do not have a United States or a Canadian nexus, funding your policy in kind with digital assets can be done.
There you go. So we work with people globally. We have people from the
Sure.
Middle East and the UAE, and we've got people
Well,
in Europe and
and it'll benefit them, but it's also subject to change. Like you said,
right.
there is so much development and uncertainty around the legislation of cryptocurrency. Is it possible that U.S. folks can be able to fund it with crypto in the future? I can't say that it's impossible. I can tell you that you can't do it today. But it's still important to be aware of the mechanisms because, like we said, this is a developing market, developing legislation. It's a new frontier.
Yeah, it's fun, exciting, and it's been great to work with you. And hopefully we get some cool things across the line in the near future. If people want to reach out to you, so maybe kind of drill down a little bit further on you're a consultant. You are not licensed. You actually gave up some of your licenses to be able to do what you're doing today. How do you work, and what's the best way for people to get a hold of you? And like, who's the ideal person that you would want to work with?
Absolutely. So that's correct. I'm actually licensed as a financial advisor, although I'm not giving financial advice today. And to be perfectly honest with you, I don't manage folks' money at the moment. I do not give financial advice as a course of my profession. I am onboarded with global insurance companies to do business through them as an approved consultant. I am licensed for insurance business throughout the entire United States as well. So I'm FINRA licensed and insurance licensed and all of that. The best way to get a hold of me, I'd say, would be through our website, which is rampartcg.com. And we can find a way to post that, and I'm also happy to give out my email. The best time to get in touch with me is really when you're getting into that space I spoke about before, where you have to start thinking about generational wealth planning. So, I mentioned that $5 million number for PPLI. If you're looking for digital asset exposure in an SMA structure, that's pretty much going to be the floor. That's the minimum you're going to need to contribute. So if you're at the stage where you could, reasonably see over the next year or few years yourself contributing that amount, we should definitely be having a conversation. Um, or if you are a non-US person that is thinking about moving, pre-immigration is a huge application point of PPLI. So I'll always be happy to speak with you there. And yeah, I think that describes it pretty well if you're approaching those numbers. But I'm happy to speak with anybody. So don't hesitate to reach out.
Well, again, I just want to say thank you for taking time out of this. Again, um, just I've always really enjoyed working with you. I'm glad to share, our relationship with the audience. Any, you know, just kind of parting words for people. Any, things of wisdom that you could leave before we sign off.
What I would leave just sort of puts a bow on something you said earlier, which is nobody likes thinking about their mortality. And even more than that, we're talking about an expense here. Putting these solutions in place is not going to be free. Um, I encourage people to consider, to envision, and it is not going to be a fun exercise, but envision, a world where you pass away without this planning and your loved ones are stuck with these bills and stuck to sell assets and stuck in probate. You know, if you could from up above at that time pay to make that problem go away for them, how much would you pay to make that happen? And that's how I want you to think of it. My parting words will be, one of my mentors told me, at the end of the day, we're in the peace of mind business. That's what we're really selling, is for folks to be able to put their head on the pillow at night without worry. Um, and that's what makes me feel good about what I do. So excited to speak with you and all these folks about that.
Absolutely. Thank you again for taking the time. We'll have your links in the show notes below, and we'll see you guys on the next one.
Have a great day, everybody. Bye-bye.
Oh, I got Here we go.